Well, guys, it is official. XYLG is finally added to my platform. This means it is seriously time to reconsider why I'm invested in Jepi. As I'm sure you guys know, XYLG and Jepi are two top competitors to one another. They're both based around the S&P 500, have a covered call strategy, and provide a high dividend yield and a competitive overall total returns. Now, I bought into Jepi before it was cool, so I started buying this in March of 2021, and compared to XYLG, or really any investment for that matter, Jepi, in hindsight, was one of the best performing assets I could have bought during a very difficult market. But recency bias is a real phenomena, and in this video, I want to explain why I think the overperformance of Jepi is behind us. I'll be showing in detail the past performance and the characteristics of XYLG versus Jepi, as well as my own personal strategy and goals here. So the video should be fun. If you guys enjoy, consider leaving a like, subscribing. So why not Jepi? Well, my first point here is because of the relative outperformance Jepi has been enjoying recently. And this is why everyone loves Jepi right now. The ETF itself is young, and for most of its short history, it's been experiencing this outperformance. And in my opinion, people wrongly assume that this outperformance is the norm, which it is not. So recently, stocks and bonds fell about 18%, the Nasdaq lost a third of its value, and Jepi, due to its very high dividend, only fell 3.5%. Excluding the dividend, it is down about 14%, which is still better than the rest of the market. Perhaps a better way of asking this question is, what does Jepi's management expect long-term from their super popular ETF? So they expect about 6 to 8% annual returns, or about 85% of the market's long-term upside potential, with a yield between 5 and 8%. So the current insane dividend yield and the market-beating returns, JP Morgan's own research indicates that there's just a 6% likelihood that this will continue long term. So that's my first point. The outperformance of Jepi will not continue. If you're like me and 2 years ago you bought into Jepi, it was a great investment, it served its purpose, but considering market conditions are changing, this might be a good time to take that relative strength and deploy it elsewhere. And that brings me to my second point here, which is personally in my portfolio, I want it to be an all-weather approach. I don't want to have investments that only do well in certain market conditions and I have to worry about timing the purchasing and selling of these various assets. And to give you guys my thoughts on the general market right now, I do have a personal conviction that the worst of this cycle's bear market is behind us. You guys know that I like to use the VIX, which is a measure of fear and volatility in the market, to identify good buying opportunities. So we can see here back in 2020 and 2008, we had spikes in the VIX, which in hindsight were indeed good times to buy. And this indicator here is the Kappa curve, which has a similar idea behind it as the VIX. The big difference here is it applies over longer time frames, not necessarily the day-to-day events. Do keep in mind that no indicator is bulletproof, but there's some that I like to look at, this being one of them. And generally, when this dips below zero, it does historically indicate a good long-term buying opportunity in the market. And after a year and a half of a market pullback, this indicator is back below zero. Also, the latest reading of inflation is 5%, down from 6%. It looks like they're going to raise interest rates just one more time. Company earnings are still looking strong, and the unemployment is near a historic low still. And that's all just to back up my belief that eventually, pretty soon, we're going to be turning a corner into hopefully a long sustained bull market. That's not to say I don't think there's going to be any more volatility, but generally things might start moving up again. And if that is indeed the case, then the outperformance of Jepi most likely is going to come to an end. And historically speaking, at least, XYLG should perform better, relatively speaking. So if we look prior to 2022, during the end of the last cycle, Jepi is this green color, XYLG is orange. This is the total return, by the way, so including that heavy dividend from both. And it's pretty clear to me that as we get deeper into a bull market, the gap in performance between XYLG and Jepi just continues to magnify in XYLG's favor. I also find it quite valuable to take a look at just the price return of these assets. Of course, for the strategy here, the dividend is a huge portion of that return, but ideally, even though these are income assets, you want the underlying share price to ideally increase, or at the bare minimum, maintain a consistent price level over time. What you don't want to see is the long-term degradation of the price and it never recovering. That would indicate to me that it is not sustainable. And we kind of see that with XYLD and by extension, QYLD. Yeah, so QYLD in red here is even worse. Now, Jepi in this green line is better than XYLD. It has some level of price appreciation. And over this entire span of just shy of 1,000 days, Jepi is up a mere 3%. And XYLG simply had stronger price appreciation, even excluding the dividend, with a maximum spread here of about 12%. Of course, since then, Jepi has had this period of overperformance, but even so, XYLG is technically still ahead by a hair. And with my belief that soon we will be entering back into a bull market, XYLG is just going to reopen this gap. And then my final point here is the predictability and safety. I'm sure you guys know that Jepi has an active management team. They follow a few guidelines, but ultimately they can have a lot of freedom in what they choose to do or not do. And it's just very difficult to try and predict where Jepi is going to be even just 2 years from now. And on the other hand, XYLG exactly follows the S&P 500 with a systematic covered call writing strategy on top of it. So with this fund, it's pretty easy to say that in a couple of years' time, it's going to be performing relatively similar to the S&P 500. So these are my core reasons for why I think it's time to sell Jepi and transfer into other assets. And who knows, there's a high possibility that one day I will buy back into Jepi, maybe at the end of this next cycle when valuations get high again and a pullback is extremely likely. Although I might not do that because Divo is another one of these kind of similar covered call funds, but it's even more defensive than Jepi. If we filter by just the price action over this time, we can see that Divo is the real value king here. But I haven't made this trade yet, so please leave your thoughts in the comments below and try to sway me one way or another. If you guys are still watching and enjoyed, I appreciate a like, subscribe, and thanks for watching.